Hello ladies and gentlemen, I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's outlook, we are starting with the Bank of Japan. It largely stuck to the script in its rates decision on Friday, maintaining its massive asset buying program, which increases the monetary base at an annual pace of 80 trillion yen. Japan's Nikkei 225 index, meanwhile, hurled itself back above the 20K mark after settling below the key psychological mark for the first time since May 19 in the previous session. The yen also showed limited reaction after the Bank of Japan kept monetary policy unchanged, as of course investors expected, retiring its pledge to increase base monetary at an annual pace. The dollar inched up 0.1% on the day to 123.04 yen, but was down from this week's high of 124.465 yen. China's Shanghai Composite Index widened losses beyond 3% on a flurry of initial public offering expected today. According to some of the analysts, the Shanghai Bourse is now down more than 10% from its June peak and has entered technical correction territory. 25 new listings are expected to take place, and it was estimated that a record of 6.7 trillion yuan worth of funds is being locked up for subscription to these IPOs. Meanwhile, the land and under Australia's S&P 200 index recouped nearly all of Thursday's 1.3% slump, thanks to stellar gains in this resources sector. The euro held steady at 1.1364, about 9.9% up this week. The common currency was more of a reflection of the dollar weakness rather than demand for the common currency, given Greece's future in the eurozone was hanging in the balance. Athens and its creditors have been deadlocked over a debt deal for weeks, and if unresolved, could see the cash-strapped country default on payments due at the end of this month. Investors are still clinging to the hopes that 11th hour deal will be struck. Sterling held steady at 1.5882. On Thursday, it had seen a 7-month high of 1.5930, partially on speculation that the Bank of England may raise interest rates earlier before the Fed. Gold in the commodity sector on Friday retained most of its gains from a sharp rally in the previous session, with prices on track for a second weekly jump, bolstered by the Federal Reserve's caution over a U.S. interest rate hike and, of course, softer dollar. The metal eased slightly to 1199.40 an ounce throughout the Asian session after a 1.3% gain on Thursday. That was the biggest daily rise since mid-May. It has gained 1.6% this week. Investors, of course, positioning remains bearish, with assets of top gold-backed exchange-traded fund SPDL Gold Trust at their lowest since 2008. And of course, speculators increasing short positions. Asian physical demand is still sluggish, as a tight price range and better stock market yields have kept consumers away. Demand could take further hit with the overnight jump in gold prices. Oil in the energy sector, of course, prices, however, were little changed in a thin trade on Friday, with a forecast of higher output by U.S. shale oil production this year, adding to worries over demand and, of course, preventing the market from extending the previous session's gains. Without much of a change in fundamentals, however, as well as changes to dollar strength, crude oil prices continue to move sideways, and we believe that this is likely to continue for today, as we do not expect much change in the prices. And in today's calendar, the most important high volatile news will be at 12:30. That's the Canadian Consumer Price Index and retail sales. That's all for today. Thanks for watching. See you next time. Bye-bye.